Hello, everyone. My name is Mark. I'm the stock market jobber. Thanks for checking out my masterclass here on technical analysis, which I am happy to do. Um, Now, I'll just give you a little bit about my background. I do have the Chartered Market Technicians Association designation. That's the CMT. I've had it for over 20 years. And I also have extensive trading experience in the institutional trading world. I was brought into the industry by Mario Gabelli, who's the great money manager. He hired me out of business school when I was at New York University, the Stern School of Business. I traded directly for him. After a few years, I made a move over and traded directly for Steve Cohen, who could be the greatest trader in history over at his firm, SAC Capital. Um, from there, I went on to become the head of trading at three different institutional money managers, where we managed well in excess of $1 billion. I've overseen the trading of various hedge fund strategies, deep value, high frequency. I was a market maker. So when it comes to trading, I've been around the block a few times. And I think the reason why this technical analysis class is going to help you more than some of the other ones out there is because I have real life experience. A lot of these other people, my competition, if you will, they've read a couple books or whatever, and that's it. And maybe they trade their own account, but they've never traded significant amounts of money. So let's talk about technical analysis. Now, analysis has a bad reputation, but in my opinion, unfortunately, it deserves it. And this is because most practitioners don't understand what it is that they are supposed to do. They look at patterns and they kind of find them on a chart. Oh, this looks like this pattern, this looks like that pattern. But they don't understand that what we're really looking at is if you perform technical analysis correctly, what it is, it's a study of supply and demand dynamics and investor psychology. And you got to view every chart through the prism of what does this tell us about supply and demand. We're looking for things that are out of equilibrium. As a matter of fact, I like to call what I do market equilibrium analysis. I don't really like the term technical analysis. So I would call myself a market technician or um, a market equilibrium analyst, right? So anyway, I don't know where the name comes from, but let's just kind of move on here. And as we go through this, one of the things I want you to remember, and I will show you a couple examples, is that technical analysis has a fractal nature. The same principles apply to all time frames. In other words, you could look at, we're going to go through what support is, what resistance is. You could look at support on a chart that's there for one day. You could look at support on a chart that's a year, covers a year. You could look at support on a chart that covers 5 years. And the reason why there is this fractal nature is because technical analysis is an illustration of mass psychology. And whether you're a short term trader or a long term trader, you still have the same psychological makeup. So I'll get into that a little bit more, and we'll look at some charts of different time frames. Now, technical analysis, not reading tea leaves or astrology, because people say, "Oh, you're one of those chart people. Aren't you guys like astrologers?" Well, maybe a lot of people, the technical analysts are, but they're not the good ones. So things like Fibonacci, Elliott waves, Gann theory, harmonic charts, this stuff is a farcical myth. All right. People that are Gann theory people like think that Gann acquired this massive fortune and he had these brilliant trading strategies. And it's just not true. I've actually read the books that were written by Gann and not about Gann. And I don't know how it's become such a mythology. If he saw what was called a Gann chart, he wouldn't even know what it was. Somehow his writings have gotten turned into all this bogus mumbo jumbo. And a guy by the name of Dr. Alexander Eller went and found Gann's son because Gann passed away, I believe, in the 50s. And he said, no, my father was nothing like that at all. He had a newsletter. He was an unsuccessful stockbroker, and he had a newsletter. Then he started a newsletter. He made a lot of bad calls. He said when the Dow Jones was, I think, around 230, that it would never go higher than that because he thought that FDR was going to destroy the country with the New Deal. And he also predicted we would go to war with Russia and so forth and so on. So I don't know if you guys like this stuff, whatever. I don't care. But in the institutional trading world, no one looks at stuff like this. All right. What we look at is what are the important price levels, what are the important trends, what's the momentum, and what's the psychology. So it doesn't need to be as complicated as you might think it is. So technical analysis has its bad reputation, it deserves it, but that's because a lot of the people that practice it just really don't get what they're supposed to be doing. Now, this is one of the most important fundamentals of technical analysis, or probably the most important, at least in my opinion. Sometimes some price levels are important and other price levels aren't. And sometimes we know why, and sometimes we don't. For example, people like to trade at nice round levels. So people might say, oh, if it gets to 100, sell it. If it gets to 100, buy it. They don't usually say if it gets to 99.43 or if it gets to 100.56, buy it. So if something gets to a nice round level, there's a good chance there's going to be support or resistance there because that's just how humans like to think. They like to do things in nice round levels. A lot of times, probably most of the time, we don't know why a level gains importance. But sometimes these levels that are important can retain their importance for months or even years. This is what we call market memory. So support, notice how I have demand, support and demand, because they're kind of the same thing. Support is a concentration of buyers who are all trying to pay the same or close to the same price for new shares or whatever financial market it is, cryptocurrencies, bond market. Uh, when markets sell off or going lower, it's because there's not enough demand or buy orders to absorb all of the supply or sell orders. So the sellers are forced to offer their shares at a discount, and this forces a downtrend. When we get to a support level, the tide turns. All of a sudden, there's enough demand or buy orders that the sellers can sell all they want without pushing the price any lower. So this is why market sell-offs tend to pause or halt when they drop to support levels. Now, if a price goes below a support level, we call that breaking, if a support level is broken. This is typically a bearish dynamic because it illustrates something. And remember, everything we look at has to be viewed through the context of what does it tell us about supply and demand. If something starts trading below the support level, it tells us that the buyers or the investors who created the support with their buy orders have left the market. Anytime you take demand out of a market, it could set the stage for the prices to move lower because if people want to keep selling, they're going to have to keep offering their shares out at a discount. So these are our support levels. Here we have a clear one for Facebook, or now called Meta, and we can see that we're going lower, right? Not enough demand to fill all the supply, so the sellers are forced to try to sell at lower prices. But when we got down to 157, we can see clear support. Now, why is there support at 157? I have no idea. It's just where the buyers decided to come into the market. A lot of times when you get to support level, we'll get a bounce, a tradable bounce off of it. Now, why does this happen? Well, this is because some of the buyers or investors who created the support start to sense that there are these other buyers around. That's why the share price isn't going lower. So they get nervous and they say, I don't want to miss this. So instead of paying 157, I'm going to pay 158. I want to have the highest price in town, so the sellers come to me. If I'm at 157 and someone is willing to pay 157 and a half, well, then I'm going to miss out. So that person might go to 158. Then someone else sees that, they might go to 159, and so forth and so on. And it creates a snowball effect. So a lot of times when we get to support, we get a rally off of it. When things get to important levels, it's as traders, this is kind of what we're looking for because an important level is like a fork in the road. Stocks or markets or whatever, I'm going to just use the term stocks just to make it easy. But when stocks get to an important level, it's like they get to a fork in the road. They either tend to reverse or break through or break down. It's pretty rare that something gets to an important level and just kind of hangs out there for a while. So now resistance is the opposite of support. When a market is moving higher, it's because the buyers can't find enough shares. There's not enough supply or sell orders to fill all of the demand or buy orders. So the buyers are forced to be willing to pay a premium, and that forces an uptrend. Now, when a resistance level breaks, it could be a bullish dynamic because it tells us that the investors who created the resistance with their sell orders are out of the market. So we're taking supply off of the market. So when you take supply out of the market, it could set the stage for a move higher because investors will have to be willing to pay a premium, and that forces an uptrend. So we have support levels, we have resistance levels. These are our important levels, and we could see here uh, with Dow Inc. resistance up around here, the 70 level, and resistance here. Now this is a year later. This is an example of market memory. Sometimes these levels could retain their importance for a long time, and I don't have it marked out here, but you can see that this level here was support, and it became support over here. This is pretty profound, actually, and people take it for granted. But if there's this narrative that like you can outtime the market, and you can. I know a lot of people that have done it. I mean, I've done it. The key is just knowing what to look at, and what do you have to look at? What are the trends? What are the levels? What's the momentum? All right. I mean, that's pretty much it. The we One of the things I teach at Stock Market Jobber is that if you want to be a successful trader, you need to let the market tell you what to do. You can't just kind of come in one day and say I'm going to do this. You have to come in and say like, all right, what's going on in the market today? For example, say you bought this Dow down around here, and you say to yourself, you know what? I'm going to sell this if it gets to 75. Well, guess what? You made the right call. You thought it was going to go up, and it did, but you're trying to tell the market what to do. Oh, if it gets to 75, I'll sell it. If you looked at this chart and you understood this concept of resistance, you would have said, there's a good chance this doesn't get to 75. So you know what? I'm going to go sell it around 69. It's not as good as selling it at 75, but it's better than missing it. So in that situation, you're letting the market tell you what to do. You're letting the market tell you where to place your sell order. So the best traders come in every morning and they're kind of agnostic and they have open minds and they just see what's going on and they let the market speak to them. The market speaks to us by how it acts when it gets to these important levels. Now, this is pretty interesting. We've seen that a support or a resistance level can stay intact for a while. Levels that were support can turn into resistance. Now, this seems kind of strange, but this happens because of buyer's remorse. Remember what I said about charts being a reflection or an illustration of investor psychology. So, a support level can become a resistance level because someone could buy something at support, say they buy it at 20, and it has a little bit of a bounce and it goes to 23, and they're like, all right, well, this is great. I bought it at 20, it's at 23. But then it reverses and it goes down to, say, 17. Now this investor is underwater and they might say to themselves, I made a mistake. I want to get out. But I'm only going to get out if I can get out at break even. So I'm going to wait to see if this gets back up to 20 and then I'm going to sell it. So if you have enough of these remorseful buyers placing sell orders at the level they bought at, well, the level that was support can turn into resistance. And you can see this on a lot of different charts. Here's our technology spider, right? Notice this to within a point. Can you consider how big this sector is and how many billions of trillions of dollars it's worth? It's pretty amazing that you can get such precision. This is this is kind of profound because all these people that say you can't outtime the market or the market follows a random walk, they're clearly wrong. Another thing about psychology is, well, here we have buyer's remorse, right? Support becomes resistance. We have people who bought here get remorseful. They decide to sell. It's really important to understand how much psychology affects the market. That's what we're looking at. When you see a big move lower like this or a big move higher like this, the media always tries to attribute it to some kind of fundamental reason. Oh, the market's up because of COVID. The market's down because of COVID. The market's up because of Ukraine. The market's down because of Ukraine. The vast majority of moves in the market are just driven by investment psychology. I mean, why would this particular sector gain such a huge percentage in one day and then only to fall back to that same valuation a week later? There's really no explanation for it other than, well, it's just investor perceptions. Like we talked before, right? About why things rally off of support. Things can get to resistance and sell off. This is the opposite. The investors who created the sell orders, I mean, created the resistance with their sell orders, start to feel like, oh boy, there's other sellers lurking around here. That's why the price isn't going higher anymore. So I don't want to miss out. I need to have the lowest offer in town so the buyers come to me. So we're trading at 163.50. Well, I'm going to go to 163. Someone else says, hey, it looks like someone's trying to sell at 163. I'm going to go to 162. And it becomes a snowballing effect. So that's why we rally when we get to support, because we got anxious buyers trying to pay more than other buyers. And the reason why things fail at resistance or sell off at resistance sometimes is because we have anxious sellers out there undercutting each other. But it's just really, really important to understand that what we're looking at here is an illustration of psychology. That's the proper way to view a chart. We can see down here, it was support here, support turned into resistance. You know, the vast majority of these intraday moves here are just investor perceptions. There's no like, you know, what they're telling you on CNBC or on Fox Business News or whatever financial thing you watch or whatever someone's saying in some chat room. The vast majority of the time, they're just completely wrong. And I think the reason for that is because they're journalists. They're not former traders. All right, let me keep moving along here. Oh, here's a good example of support becoming resistance, right? This is JP Morgan. So remember, people buy when the price goes lower. A lot of the investors who bought regret doing so. They tell themselves, if I can get out at break even, I'm going to do so. So they wait for the stock to rally back to their level and they place their sell orders at the same level they bought at. If you have enough of these remorseful buyers placing sell orders, support can convert into resistance. 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 So no academic in the world can explain this. No college professor could probably explain it. But you got eyes and you can see. Look, I mean, it's pretty darn clear. Markets don't go in straight lines. So a sell off or a rally is usually, it's like a staircase. It's a series of trading ranges. And what was the bottom of the range in a down market becomes the top of the next range. So that's that conversion of support turning into resistance. So for whatever reason, these are the important levels. I don't know why it's not right in here in the middle or why it's not at, say, 150, but we don't need to know. We just need to know where these levels are. Now, levels that were previously resistance can turn into support. This happens for the opposite reason. It's not buyer's remorse, it's seller's remorse. Investors sell, they watch the price go higher. A lot of these investors regret doing so and they become remorseful sellers. A lot of them tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price that I sold them at. So if you have enough of these remorseful sellers placing buy orders at the price they sold at, the level that was resistance can turn into support. In other words, someone sells something at 20 and it goes to 25 and they tell themselves, man, I shouldn't have sold that. I made a mistake. If it comes back to 20, I'm going to buy my shares back. I think I made a mistake, but I'm only going to get back in if I can get them at the same price I sold them at. So if you have enough of these remorseful sellers placing buy orders at a former resistance level, the level could become support. Here is our healthcare spider. This tracks the healthcare sector, and we can see that resistance here became support here. So this is this is probably January of 21, and this is June of 22. So we have market memory, resistance becoming support. You can see up here we have a resistance level. You can see here we have a resistance level. And we even have a support level coming through here. I haven't marked these out, but you can see them. All right, let's keep moving along here. It's really kind of a shame. I actually get a little upset when I see people pitching these things like, GAN theory and Elliott wave because it's just not right. It's that's not how things work in the real trading world. I mean, maybe this stuff's kind of interesting to talk about it, but I don't know anyone who makes money off of it other than the people that sell the courses. But I've known a lot of people that have made a lot of money by just understanding these basic principles of resistance, support, market memory, how the levels can convert back and forth between one and the other. I mean, if you're thinking about buying something and it's in a downtrend and you start thinking, where should I place my buy order? Well, if you look at the chart and you look into the past and you see a level that was support or resistance, we're getting close to it. Well, that would be a logical place to have your buy order. If you say, all right, well, this thing went from 40 to 36, it's down 10%, I'm going to buy it. Well, you're kind of just guessing. But if you say, you know what, 32 was a resistance level, there's a good chance there that seller's remorse might create support around 32, which it did here. You say, all right, well, I'm going to place my buy order down around 32. So you're not going to get run over. I mean, of course, it's not a guarantee. Eventually, the support could break, but it stacks the odds in your favor. This is an example of market memory here. And you could see that some of these levels can stay intact for a really long time. This is CVS, the pharmacy. We can see here that there was resistance at 83 for 2.5 years. This is an 8-year chart. We can see here that I think it was February of 22, last year, about a year ago, the stock rallied on earnings. And where did it run into resistance? The same level that it hit resistance in July and August of 2015. So 8 years before, or 7 years before, sorry. Um, so this is what traders and the savvy traders in the institutional world are looking at. What are the former peaks? What are the former valleys? What are the former resistance levels? What are the former support levels? The thing about those other methods, if you can even call them that, like GAN theory, Elliott wave, it's like they don't really illustrate support and demand. So they're just mythical. I wouldn't even bother with them if I were you. And we can see here an example of what was resistance turned into support. Support of 52 for a year. Now this is a really amazing example of market memory coming up here. As a matter of fact, this is probably one of the most interesting things I've seen, right? It's a 25-year chart. Look at where Bristol Myers hit resistance back in October of 99, right at 74. Look at where it hit resistance in July of 16, right at 74. So that's a pretty amazing example of market memory. Is it people that bought here or waited all those years to get out at break even? I don't know. It's probably more of like an algorithmic thing, just a text we're at a former peak. But the reason why a resistance level can stay intact is because there are people who bought at the resistance, and when the price goes lower, they tell themselves, I made a mistake. Once again, we have buyer's remorse, but it's a little bit different. They tell themselves, if we get back up to that level, I'm going to get out at break even. So we have people that bought at resistance trying to sell at resistance or the resistance level the next time it gets there. And a lot of people might not even know that it's at a former resistance level because they're not looking at charts and they're not doing the work and taking the time to learn like you are. But I can't say it enough. It's levels, trends, momentum, and psychology. That is the keys to being successful. And this is the stuff that us institutional traders talk about. All right, so now we're going to talk about trends. So markets are always trending. Even someone who doesn't know anything about the stock market can look at a chart and say, it's pretty obvious that prices don't jump around here in random waves. Markets are always doing one of three things. They're either moving up, moving down, or moving sideways. So I like to say that the only guarantee in the market is that the trend will eventually change. I like ascending and descending triangle patterns. We're not really going to, believe it or not, I know this is a technical analysis class, but we're not really going to talk too much about patterns. Because in my opinion, it's more important to understand what it is that the patterns illustrate. No one's going to pay you because you said, all right, well, this is that pattern, this is this pattern. But you can make money if you understand the supply and demand dynamics that I'm talking about. So I like ascending and descending triangles. We'll cover them, um, but they tend to be pretty reliable patterns of continuation. They tell us, all right, the trend is going to keep continuing in the way it has been. The other type of patterns that people look for are reversal patterns. So there's three ways to identify a trend reversal: a trend line break, a moving average crossover, or a reversal pattern. The reversal patterns that I like are the V tops and bottoms, rounded tops and bottoms, and the old head and shoulders. But we'll see some of those in a bit. I'm going to go through just a bunch of different charts and kind of show you what I'm talking about. Momentum is a way of measuring how far a stock or a market has moved in a particular period of time. Now, most of the time, the trading is within what would be its typical or historical or usual trading range. If something gets above that trading range, we say it's overbought. If something gets below it, we say it's oversold. Those are referring to momentum. If something is oversold, it's because the sellers have really gotten aggressive. If something is overbought, it's because the buyers have really gotten aggressive. Now, this is important because markets tend to reverse back to their average. If something is overbought, there's a good chance it attracts sellers into the market and it goes lower. If something is oversold, there's a good chance it attracts buyers into the market and they move it higher. So this is why we want to pay attention to momentum. When something is oversold and it gets to support, there's a good chance it's going to rally or bounce. I've known people that have literally made careers off of that. If something is overbought and it gets to resistance, there's a good chance it's going to reverse and go lower. So if you have a stock and you're thinking about selling it and you don't know where to sell it and it gets overbought and hits its resistance level, well, there's a good chance it's going to go lower. If you're thinking about buying something and it gets oversold and gets to support, there's a good chance it's going to go higher. It's not a guarantee, but you want to just stack the odds in your favor. Every trader takes losses, even the greatest ones in the world. We'll talk about that more in our market psychology class, but it's this is not a it's not perfection. It's not a science, right? And the people that have tried to make a science out of it, like all these artificial intelligence funds, for example, or these funds that are run by AI, they have not done well. And it's because they treat this like it's a chess game. But the market is not a chess game. In chess, the rules are always the same. In the market, they're not. What works today might not work tomorrow because what we're doing is looking at a aggregate or a mass psychology of millions and millions and millions of different investors. And these millions of investors are people and they have emotions. So what works today might not work tomorrow. I think a better analogy than a chess game is a poker game, because if you're a great poker player, which I'm not, I don't really gamble, but if you're a poker player, you have your strategies, right? You have to follow the rules, but the person who's sitting across the table from you is a human, and they're going to have different emotions. So what works today might not work tomorrow. For some reason, maybe the person is a little rattled because they didn't get a good night's sleep or they got into a fight with their spouse or what have you. So that's why we can't ever forget how important it is to consider the psychology when we're looking at a chart. It's like I said before, a chart is an illustration of mass psychology. So there are lots of ways to measure momentum. I mean, probably hundreds. And it's important to understand that all these are just different ways of measuring the same thing. And that's how far something has moved from point in time A to point in time B. I see a lot of newer traders, they have, maybe five different momentum oscillators on their chart. To me, that's just confusing because, like I said, it's different ways of measuring the same thing. So it's a little bit overkill. I recommend to my students that you just pick two or three oscillators that you like and get really comfortable with them. There's no one oscillator or momentum indicator that's better than another one. What works for someone might not work for someone else because everyone has a different eye and everyone sees different things. So let's look at some of these popular ones. Now I basically exclusively use relative strength and Bollinger Bands. But there's stochastics. This is a popular one. Moving average convergence divergence is a popular one. Rate of change. I mean, there's dozens, if not hundreds. But they're different ways of measuring the same things. All right, now what we're going to do is just look at some charts, which I just quickly uploaded, and just see how every chart can kind of teach a lesson or illustrate the dynamics that we've been talking about. So this is their basic materials ETF, XLB. And we can see here how important this $81 level is for this particular security. It was support here in 2021 in the summer. Then in early 2022, it became support again. Then it converted into resistance. Remember, we have people who bought experience buyer's remorse when the price goes lower, and they tell themselves, I'm going to sell if I can get out of break even. So we have remorseful buyers placing their sell order at the same level they bought at. If you have enough of them, well, the level that was support becomes resistance. Now we have the opposite over here. The level that was resistance turns back into support. This is because of seller's remorse. See, this is what I mean. It's all psychology. Levels shift back and forth between support and resistance because of buyer's remorse and seller's remorse. It's not magical. It's not mystical. It's not Elliott wave or Gann theory. It's just understanding supply and demand dynamics. So we can see up here 84 was resistance. Now, why is it not at 83 or 85? I don't know. But I don't need to know. For some reason, that's where the sellers came in. So let's just say hypothetically, if I was to buy this and I was wondering, it's rallying, where should I plan on selling it? Well, I would be looking at the 84 level because market memory tells us that what was an important level or was important resistance or support can remain so for a long time. Down here we have a way of measuring momentum. This is what we call the relative strength index, the RSI. If this blue line gets below the red line, it indicates oversold conditions. If the blue line gets above the red line, it indicates overbought conditions. Now we can see here we're overbought right up here. That would have been a good time to sell. Oversold right up here. It would have been a good time to buy. Overbought up here would have been a good time to sell. Oversold would have been a good time to buy. Let's see, that's about right there. And here's what I'm talking about. A market that's overbought and gets to resistance tends to sell off. Here we were oversold, and that's right at the bottom here. So we can see these principles: momentum, levels, and then what are the trends? It's like you could look at pretty much any chart of anything that's liquid and see these principles showing up. Now this is a one-day chart, and I want to show you this fractal nature of charting here. This is just a one-day chart, and we could see the same principles, right? Resistance converts into support. Seller's remorse. And now this is just a one-day chart. So this is investors who have a time frame that's short. So it might be day traders. The day trader bought it here, it goes lower. I'm sorry, a day trader sold it here, it goes lower. They regret selling, it goes higher, and they tell themselves they're going to buy their shares back, but only if they get it at the same price. Here's our ascending triangle pattern, and I told you I think these are pretty effective patterns. What does it tell us? Remember, supply and demand. Well, we have the sellers are kind of content with hanging around at this resistance level, but meanwhile, as time is going by, the buyers are getting more aggressive. They're willing to pay higher prices. That's why we have these little bottoms forming at higher levels. Markets don't go in straight lines. They go in peaks and valleys. And if the valleys are forming at a higher level than the prior valley, it tells us that the buyers are becoming more aggressive. So we have sellers who are hanging out up around here, and we have buyers that are getting more aggressive. So the sellers are kind of just hanging out and they're kind of chill. They're complacent, but the buyers are becoming more aggressive. So whatever market it is, if you have complacent sellers and buyers becoming more aggressive, well, it sets the stage for a move higher. And we could see we got resistance. This peak was resistance, peaked right here. So say you had bought it here. Oh, we're breaking through resistance. That means the sellers are out of the way. So there's a good chance it moves higher. Well, where do I want to sell? Oh, let me look at this former peak. And that's where we got. I mean, of course, we went higher after that, but still, if you were a day trader, you could have sold here and then bought it back down here and said, all right, well, former resistance level, there's a good chance there's support there. So this is an illustration of this fractal nature of charting. If I didn't tell you that this was a one-day chart, and if you didn't see the time horizon down here, you wouldn't know if this was a 5-year chart, a 1-year chart. The point is that the same principles come into play because it's just human beings with different time frames, and charts are a reflection of human behavior. Here's natural gas, and we could see here, after this massive sell-off that started in August, we found support right around 240. I mean, it's lower than that now, but for about 2 weeks it was at 240. That goes all the way back to late 2020 and 2021. So that's an example of market memory. Here we have, once again, our ascending triangle. We have sellers complacent, buyers getting more aggressive. This tells us that this trend is probably going to continue. Here we have the opposite. We have the descending triangle. We have the buyers who are just chilling and the sellers who are becoming more aggressive. And that tells us that there's a good chance we're going to go lower. So I don't really talk about a lot of patterns. You never hear me talk about a wedge pattern. I don't even know what a wedge pattern is. We could talk about, like, is this a V top? And yeah, I mean, you could say that. Is this a V bottom? Yeah, you could say that. When a market is getting set up to reverse, the price action manifests itself on a chart as something that becomes a pattern. Now, if it's a quick reversal, like these were, you could say, all right, it's a V pattern. But it doesn't really matter. The thing is you want to just see that the trend is changing. And a V pattern is an illustration of a quick change. If it was a slow trend change, you could say, oh, it's a rounded bottom or a rounded top. That's the way the action would manifest itself on a chart. So again, it's not important to just remember or memorize the names of all these various patterns. What's important is understanding what the patterns illustrate. And like we could even see here, resistance here became support here, right? You can call it whatever you want. The triple Lindy pattern. We could see here, resistance here became resistance here. Every stock or market has a different personality. That's because different people trade it. And for some reason, natural gas is traded by a lot of people that jump onto quick trend changes. So that's why we see a lot of V's on this pattern. Here's Apple, and we could see resistance here around 155. Now here's an example of a trend line, right? We're going lower, and when we cross this trend line, it tells us that there's a good chance we might start going higher. The downtrend has been broken. And this just happens because the way charts are recorded. If something is going down, the first thing it needs to do before it goes up is stop going down. So the way we record the prices on the chart, we're going to end up crossing that trend line when the price stops going down. So it's like a wake-up call. A trend line isn't like it's not like a support level or resistance level. It's really just a graphical illustration. Now we see we've gone into this uptrend. We got to resistance. And what's been going on over the last 2 weeks? Well, we've been going kind of sideways. Now we cross that trend line. It could be an illustration that the bears are about to take over. Think about it like this, right? Here's the red team pushing the ball down the field, and we get the goal line stance here, and the blue team takes over. And the first sign that that's going to happen is the price stops going down, and just because of the way charts are recorded, well, we're going to cross the trend line. Opposite is true when we're going higher here, right? The blue team's in charge, taking the ball up the field. We get up here, there's resistance. Now we've stopped going higher, and just by the way charts are made, we've crossed the trend line. So this could be a graphical illustration that we're about to go lower, or the red team's about to take over. These red lines on this chart are another way to measure momentum. In addition, or like we saw the RSI indicator, this is a different way. This red line is 2 standard deviations above the 20-day moving average, and this red line is 2 standard deviations below the 20-day moving average. These are called Bollinger Bands. Now this is important because according to statistics, 95% of all trading should be within 2 standard deviations of the mean. If we exceed one of these thresholds, well, there's a good chance that we're overbought or oversold, and there's going to be a reversal. So we could see we exceeded it up here. And this gets the attention of a lot of these algorithmic programs that are based on statistics and probability theory, and that's really what most of them are based on. So these Bollinger Bands have become much more effective over the last couple of years as this type of trading has gotten more popular. So we could see that. We could see we have support down here. Remember what I said, oversold markets that get to support tend to rally. Here we have what we call a gap. We gapped down and we made a quick move right back up through it. So there's a saying on Wall Street, it's that gaps refill. And the reason why is because of psychology. We talked about how one of the reasons why there's resistance is because we have remorseful buyers placing sell orders, right? If we gap through these price levels, meaning we didn't trade at them, on this day we closed here, on this day we opened here, closed here, opened here. If the security or the stock didn't trade at those levels, well, just by definition, you can't have remorseful buyers trying to place sell orders because no one bought. It didn't trade there. So when we talk about how gaps refill, that's what they mean, right? If we gap one way and the price goes the other way and then it reverses and comes back to those price ranges, we tend to get these quick moves right through it. And this is because of a lack of sell orders. This right here, this big blue line here, this could be considered a one-day reversal pattern or a reversal day, which is a pattern. And this just shows us, the red team is in charge, and then the blue team makes the big goal line stand and turns the tide, and the blue team starts pushing ahead here. Now up here, we can see we had this big, we opened up here, we sold off to here. Who knows? Maybe this is a pattern, maybe it's not. I don't know. It doesn't matter. What matters is, oh, gee, look at that. We reversed. There was a little bit of support at this former resistance level, but then we broke through. Now we're trending lower. And notice how what was resistance became support, and now support has become resistance. So again, it's levels, trends, momentum. We don't need to worry about esoteric, crazy stuff. At least not when we're looking at charts. United Health, we can see clear resistance here. We could see resistance became support, support became resistance, and we could even put in some trend lines, right? Red, get up here, the blue team's in charge. Even though there's some down days from this time frame, the blue team's still pushing the ball higher, or pushing the ball down the market. When we cross that trend line, that's an illustration of, oh, gee, we're not going higher anymore. We're going sideways. Well, the first thing something needs to do that's going higher before it starts to go lower is to stop going higher. We can see down here again another example of a gap being refilled. So we didn't trade at these levels. So when we start to reverse, there's just not going to be remorseful buyers trying to sell. So there could be a lack of sell orders. The buyers come into the market. There's not a lot of sellers around, so they're forced to pay higher prices. And that pushes us into a rapid uptrend. All right, let's keep moving along here. Now here is another day chart, daily chart. This is minutes now, okay? So this Bollinger Bands is 2 standard deviations above the 20-minute moving average. The same rules apply even though it's a different time frame. We get above the threshold, we go lower. Here we get below the threshold and we get to a support level. So if you're a day trader, you could have been all over this. Wow, that's a big move. That's like a 10-point move in a matter of. Oh, actually, I'm sorry. This isn't a. I'm sorry. I take it back. This is a longer term chart, but we see the same principles. This goes back to. This is about a 14-month chart here. Sorry about that, or 16-month. But we can see support became resistance. Resistance becomes support. When we get above the thresholds, overbought at a former support level, good chance we're going to go lower. That's what happened. Got below the threshold here. That attracts buyers into the market. They pushed it higher. Look at this here now. Support became resistance. Resistance was resistance. It's just important to point out that this is a huge sector, and yet somehow these levels are really precise. And as traders, we understand this because we understand that charts show us psychology. But a random walker or someone who says you can't outtime the market, they wouldn't be able to explain why there's a support or resistance level. We could get resistance because there are people who bought here who, when the price went lower, regret doing so, and they tell themselves, I'm going to wait, and if this thing comes back, I'm going to sell it at the same price I bought it at so I can get out of break even. So we have remorseful buyers who bought up here, placing their sell orders up here, and if there's enough, that creates resistance. Now notice how we gapped up here. Well, because we gapped, meaning the price closed here on this day and opened up here on this day, it didn't trade at these levels. So because it didn't trade there, just by definition, we can't have remorseful sellers trying to place buy orders because it didn't trade there. So there's no one who could have sold who's now remorseful. So there's going to be a lack of buy orders on the way back, and that leads to these rapid moves lower. So here's another example of a gap refilling. And here we have support becoming resistance. Support becoming resistance. So we can see this on almost any chart. These basic principles. Okay, now here is the daily chart. So this is Norfolk Southern, and this RSI is measuring. I should have explained this before, but RSI measures how far something has moved in a 14-day time period, or I should say a 14 time period. If you're looking at a daily chart, we're looking at minutes, so this is measuring how far we've moved in 14 minutes. If we're looking at a longer term chart, it could be how far something has moved in 14 days. If we're looking at, say, a 5-year chart with a weekly time frame, it could say how far something has moved in 14 weeks. But the principles are all the same because we're looking at illustrations of human psychology, and different people have different time frames. Someone who's a day trader is going to have the same psychology of someone who's maybe a swing trader. So that's why we see the same patterns pop up in a daily chart as we do in a chart that's, say, a year long. We have resistance here, and then we have resistance here. So this is like this is like 115, and then this is like 245. So if you're a day trader, this would be good to know. We could see support there, became resistance over here. We got oversold. That was a good time to buy. Oversold here, told us that we were going to get this bounce. Oversold here, well, was a good time to buy. And it's kind of the same principle. It's not technically a gap, but when we move really fast, like we did here, you're not going to have a lot of people buying because it's just a fast move. So you're not going to have too many remorseful buyers placing sell orders. So that means we can move right back up really quickly through that level. So technically it's not a gap, but it's the same principles apply. All right, well that's it, everybody. Thank you so much. Please check out check out our website because most of what we do is technical analysis, but we cover other things as well. My goal is just to teach people how Wall Street really works, how trading really works, because there's just so much mythology out there. There's so much misperception, and I think it's because a lot of the teachers out there they just don't have the experience, you know. And if someone's only been a trader over the last 10 years, they pretty much only know, well, up until last October, I should say. But someone who traded from, say, 2012 to 2022, you know, all they saw was a bull market. They don't know what it's like in a bear market. Things act differently in bear markets than bull markets. So let me just finish up by saying, don't worry about crazy, weird, esoteric methods. Worry about what the principles of financials of markets are, and those are that some price levels are more important than others. Markets are always trending, and markets that get oversold or overbought tend to reverse. All right, thank you everybody for staying with me, and hopefully you'll subscribe to our site, and I will see you soon.